Commercial real estate is probably the highest volume business in the commercial funding sector. You have a number of different types of commercial real estate loans, from bridge, conventional, and new fix and flip rehab, which is just exploding. Bridge loans are generally interest only, 1 to 5 years. They can be as short as 90 days. And generally, they do 50 to 75% loan to value. It's a good tool for purchase, for buyouts, for cash out. If you got a partner that you want to buy them out, you can use a bridge loan until you get it refinanced or till you generate the income to pay it off. It's a very valuable tool. In purchases, if you find a good deal, great deals don't last. A bridge loan can be turned around in some as low as 7, but generally 14 to 21 days, 2 to 3 weeks, you can get a bridge loan through. Some of them are days, 7, 6, 10. And when you have that great deal, you don't want to let it get away. If you try to do a conventional product or an SBA product on there, it's going to take you probably 4 to 6 weeks for a regular conventional and 60 to 90 days for an SBA loan to close. And by that time, the deal's gone. Conventional is more like your residential mortgages, where there's a amortized rate. Generally, it's between 10, 15, 20 years. 20 years is about the max. It's usually 50 to 85% loan to value. And there are far fewer sources doing the conventional than it is doing the bridge. Bridge, they're everywhere. A bridge loan funding sources are everywhere. The requirements generally is an executive summary. The executive summary is just an overview of the principals involved, anyone who is 20% or more in the business. It is an explanation of what the business is for and how you're going to move forward. Generally, they need 2 to 3 years business tax returns, 2 to 3 years personal tax returns, and often they'll require a personal P&L and or a business P&L. And what they're trying to do is make sure that you can afford to pay it. If any funding source goes through their underwriting formula and it comes out that they think that you can afford to pay them, they're going to give you the money. If the margins are tight, they're going to charge you more. It's going to be higher interest, shorter terms. It's going to be some manipulation in there, but they're going to give you the money. Generally, they are interested in an application and 3 to 6 months bank statements. Usually 6 months is the standard. Some people will go with 3. Now, with these two products, a combination of them is often used for certain deals. You'll get a bridge loan to get it, and then you'll apply to SBA and or some conventional source to extend the payments and pay off the bridge loan. Now, another new entity is the fix and flip rehab. It is just growing exponentially in the last probably 2 years. Every month there's 3 or 4 new fix and flip operations, funding sources that are coming up. These are for non-owner occupied residential mainly. 1 to 4 unit, 1 unit, multiple unit. They'll do up to 100% of the rehab or 75% of the after repair value. So a lot of times you can come from closing and get money, or you'll get a draw afterwards. They're very lenient on credit and income because the property is pretty much the collateral for that transaction. A lot of companies are starting with blanket fix and flip programs where they will include multiple properties in the same loan. And what they'll do, they'll say 500K for 3 properties or $1 million for 5 or 7 properties. And what they do too is the more fix and flips you do, the better terms and rates you get on each one subsequently that you do. So if this is your first, then they're gonna, beat you up with the interest rate, and they're gonna, allow you the least amount of flexibility. Whereas if you got 5 or 6, the rates get better. And if you've got 10, 15 or more, then your rates really get good. You just go and sign your name and they know you know what you're doing. So the more experience you have is a lot better with the fix and flip entities. Now, right now, currently, there's a term called dry powder. Dry powder is funds that are allocated for commercial real estate transactions which are unused. The amount of dry powder that is currently available is higher than it's been in the last 20 or 30 years. There are companies begging people to take their money. So we want to help them. We want to help you. We want to help them, and we want to help you. So you need to come to us. Let us customize a product for you. Our motto is, if we can't get it for you, you can't get it. A lot of people come to us as a last resort, and we're able to help them, and we're grateful for that opportunity to be of service. But if you come to us earlier in the transaction, we can insulate you in a lot of ways from a lot of things that'll be harmful. We can help you to maximize your position in the funding process. My name is James Parker. If we can't get it for you, you can't get it. Let us customize a funding package for you. Thank you.